Day. Want to move on from this, though. Welcome Sam back into the conversation. And our next guest, Rob Haugen, the Chief Investment Officer at River One Asset Management. Rob, thank you for being with us today. Now, you are about to celebrate a very important milestone. Can you tell us about it, please?
Yeah, thanks for having me. We're coming up on our second year anniversary of our ETF, RVER, which we started back almost a few years ago here now. And we're very excited to say how things have gone and how it is to build a new ETF in this world. There's ETFs being launched every day. We're competing against each other. And we've just hit the $100 million mark, and the 2-year mark is coming up here very shortly. So we're very excited to announce that milestone, and thanks for having us today.
And Rob, you mentioned that there are just so many coming to market now. I know that you're an active ETF, which means you're sort of buying and selling to try to at least beat or outperform your index. I've just been looking across some of the stats, and there are some varied numbers, but as far as active ETFs now in the market, they outnumber passive funds. From just 2 years ago, we've gone from hundreds to now thousands. What sets yours apart?
Yeah, thanks for asking. What we do is we go after a part of the market in growth that isn't being looked at from a valuation perspective. So we think the combination of finding the big growth stocks, finding out there the new trends where everything is, and overlaying valuation is something totally different. We think that a lot of folks are doing leveraged ETFs. A lot of folks are doing thematic ETFs, attacking one little specific part of the market. What no one is doing is no one is creating an all-weather ETF that looks at both growth and value and can move up and down the capital stack, large cap, small cap, mid cap, all of these different areas. We think that ultimately will give our ETF a better ability to outperform the market over time because of that flexibility.
And Rob, you say you have this growth at a reasonable price strategy. I kept seeing that terminology when I was doing some research on the ETF. How do you balance growth potential with valuation discipline in the market conditions we have right now?
Yeah, it's actually very difficult right now. Some of the stocks that have had really, really good years seem to not care much about valuation. And if you had asked that question about 3 weeks ago, before some of the sell-off had started, you'd think, oh, you should actually just go into growth at any valuation because that's what's really worked. We're seeing right now where that can get really, really difficult for investors. There are stocks that have started to sell off in the last couple of weeks here that could sell off because of their valuation, in our opinion, 30, 50, maybe even 70 or 80%, because the income that they're going to generate is nowhere even close to what the market is assuming right now. A few of them are going to make it through, but we think you do not want to be in just pure growth or just pure valuation because you're missing the entire AI trade if you're in valuation. You want to be in that combination of both.
Whole AI evaluation type story and the thinking that some of these are stretched because as Martin Norton just told Marley, I mean, we've got a lot of sort of influential names in recent weeks sort of sounding off on this now. I mean, you've had the commentary coming from Dave Solomon, Ted Pick, even Andrew Bailey, the governor over at the Bank of England, putting his 2 cents in as well. So where do you sit on this narrative?
Yeah, we think there are a lot of stocks, not everything, don't paint with a full brush here, but a lot of stocks in the AI trade right now. They're simply getting money because these passive and thematic ETFs are getting money, and they're chasing these names well past they're ever going to go. So I think you need to be really careful about where you buy AI stocks. Specifically, today we look at CoreWeave, which is selling off. That stock is not cheaply valued, and there is a lot of growth that needs to be priced into that company. That company is also going to need to raise a lot of capital. One needs to put all of that in their calculus before they just sort of blindly buy an AI stock like that.
And Rob, you said you don't want to paint with a broad brush there across the whole AI trade. So where are the corners of the market that are worrying you the most, and where do you see opportunities?
Yeah, so as far as things that are worrying us most, it's really the stuff that's got zero revenue, low revenue, or really hasn't proven itself out as a complete company. We're looking at some of the nuclear names, some of the quantum names. These revenues, these net incomes, they all live in a spreadsheet. They don't live in reality yet. And a lot of them are not going to be able to produce what the market is hoping for. So that's where we're staying out of right now. Where to go instead, we're in a bunch of healthcare names, specifically the two GLP-1 drugs, which are having really good days today. That's Novo Nordisk and Eli Lilly. We think that's a really good place to be. But here's a different place that not a lot of people are yet. Semiconductors are very, very popular with investors, and they should be. They're having a great renaissance. But we think those companies are becoming fairly valued for their growth. What is being left behind is software names. And we're talking about these old school SaaS names, which used to carry 12, 15, even 20 times price to revenue multiples, are all at historic lows. Once this flips, we think there's a lot better prices in these software names than there are in the semiconductor names, which we have since exited recently.
Okay, interestingly, because, I've been looking at some of the sort of semi-V software spreads this year, and I mean, that has sort of been widening. And I mean, software has had a bit of a tough go this year at some stages throughout the course of the last quarters as well. I'm just wondering, you mentioned healthcare. We have got Novo up today, 7.5%, Eli Lilly, 2.5% as well. Even UNH is up 1.5%. It's been an interesting day as far as some of those Dow components. So when we look across today's market performance, I mean, this sort of rotation out of tech on these AI valuation concerns into other parts of the market, value, a bit more defensive, a bit more cyclical in nature. What's really interesting also is you've got McDonald's and Nike sort of leading the Dow. What do you make of the rotation that we are seeing?
Yeah, I mean, I think that's part of just a day-to-day rotation that happens in the stock markets. When people get a little bit nervous about some of the high flyers, they sell something like QQQ and they buy something like DIA or something equivalent to that structure. So we think that that's basically what's going on. So stocks like Nike, which really don't have any news in it going on, are new inflow monies, and some of these tech players are outflow monies. As far as the healthcare trade goes, I think it's going to be really difficult for that trade to get going until we get a decision on this ACA thing. We thought we were going to have that with the government restart this week or last week. We thought we were going to have some clarity on there. They have kicked the can down to December, but they will need to make a decision by December. So if you're looking at healthcare, we do think, like a stock like UNH, we think that you're really going to need to get that government decision out in the open first before it can do well.
And Rob, last question here. I want to bring it back to your ETF. You only carry between 12 and 25 names. And I also want to note again, you are actively managed here. What kind of edge do you think that gives you? And how do you manage risk with such a concentrated portfolio?
Yeah, I mean, the math is that if you have more than 12 stocks in a portfolio, it is technically diversified mathematically. Other people are looking for more diversification, which we understand, but that's not the point of this ETF. The point of this ETF is to try to drive alpha, to try to drive outperformance to its index. In order to do that, it really does have to concentrate in several bigger bets. It's not easy if you bet 100 stocks and have a 1% position each of them. It is really difficult to outperform the S&P. We think that ETFs that are doing that are really just hugging the benchmark. We are not trying to do that. We're out there trying to be active managers and trying to beat other passive funds.
Well, Rob, we appreciate you being with us today to talk about your ETF and the broader market as well. That's Rob Haugen, the Chief Investment Officer at River One Asset Management. And coming up, we've got options coroner Rick Ducat will join us here in our Chicago studio to take a look at Oklo ahead of its earnings after the bell. That's next on Market on Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action from